an ARF, ARF, an approved retirement fund. Think of it this way. When you're funding your pension, you're building up a pot of money. All an ARF, an approved retirement fund is when you get to retirement, you get this pot of money, you have a decision to make as to what you're going to do with the thing. 99.9% of people take a quarter of the pot, whatever it is, up to certain levels. I'm not going to bore you in the video, right? And they take it as a lump sum. The majority of that lump sum for most people is going to be tax-free. So you get that money and you can do whatever you want with it. It's in your name, it's in your pocket. You want to go to Vegas, off you go. You want to blow it on a house, do whatever you want with it, it's yours. The balance of the pot, you have a decision to make with that. The decision that, again, 99% of people use is an approved retirement fund or an ARF. All an ARF is think of it as your personal current account in retirement. So you spent 20, 30, 40 years building up this pot. And you've been looking at accumulating and you can't get at it. You can't take money out of it. With an ARF, you just take that. It's in a separate account. It's invested. We have clients who will buy direct property with their ARFs because they want to get some sort of regular income. They will buy shares. They will invest in funds, whatever. So the investment universe is very similar. But ultimately, you draw your income from that. All income is taxable in retirement. So the one difference between the ARF and anything else is obviously if you take money out of your pension, taxman has to, they gave you all this generous tax relief, they want some of that back. So they do that by taxing the income. But the good news is the income tax regime is exactly the same post-retirement as it is pre. So for most people, if they have modest levels of income, they're paying very little tax on their withdrawals from their approved retirement fund. But the real difference with an approved retirement fund, it grows tax-free. And the objective of a financial advisor is, if you're saying to us, I need an income from this pot of $30,000 a year, we have to try and get you a return on that pot as close to $30,000 a year so that you're living off the interest rather than the capital. And that extends the longevity. Because ultimately, with an ARF, it's a pot of money. If you're dipping in and the rate of extraction is greater than the rate of increase in the investment, eventually you're going to diminish the pot. And you don't want to be maybe late 70s, early 80s, and all of your money is gone. Because the number one concern for most clients when we talk to them, our retirement clients, is nursing home fees. Generally, it's a big thing for them. And so they're very interested in the longevity of their ARF. So our primary responsibility as a financial advisor for clients at that, what we call the decumulation phase, is to preserve the longevity whilst giving them the capacity to bloody enjoy the money. Like there's a school of thought that says you should keep a client's level of income steady throughout retirement. That's insane. Because if you think about anybody you know who's retired, you want money and the capacity to be able to spend your money when you're fit, when you're healthy, and you have the energy to be able to do all these good things. Because spending in retirement is U-shaped, as in we spend more in our kind of 60s to 70s, and then the rate of expenditure decreases as we hit mid to late 70s. We just get tired. Hey, we're not bothered. We've done all the holidays, right? We just become a little bit more sedentary. And then what happens is it can either tail off that way or it'll go rocketing up. What causes it to rocket up? Healthcare, nursing home fees, whatever the case may be. So our method of managing clients' money in retirement is we give you the capacity to be able to have what we call fun time, which is the first kind of 10 years of retirement, where we try and give you the certainty that when you're taking money out, you're not impacting the longevity of your pot. But you're doing so in a way that gives you the capacity to be able to enjoy it. There's no point in saving for 20, 30 years and then having a miserable retirement. Why bother? It's about giving you should enjoy your money. That's the point of the whole exercise. Enjoy it. But then what an ARF does is give you the flexibility. And that's really why they're so important and why they're so popular, because you get enormous flexibility over how you draw your money down. And to be honest with you, from an estate planning perspective, if something happens to you and you're married, it can pass to your spouse, it can pass to the children, it can pass to a charity. There is a degree of estate planning built into it that doesn't exist with other methods of drawing down your pension.